Strong corporate governance within a bank is critical for effective risk management. Strong corporate governance includes ensuring that the bank has the appropriate corporate structure to support effective risk management. At the very top of the corporate structure within a bank sits the board of directors, acting on behalf of the shareholders and offering independent oversight. Reporting to the board are board level committees, each tasked with overseeing a certain area within the bank, and often include a subset of the board along with experts in that specific area. An example of a board level committee is the Enterprise Risk Committee. Its name could vary from bank to bank, so it could also be called just the Risk Committee. We will call it the Enterprise Risk Committee, and it focuses on risk management oversight within the bank. The Enterprise Risk Committee is responsible for advising the board on what they believe is an appropriate risk appetite for the bank, reporting on the state of the risk culture at the bank to the board, oversight of the strategies to manage all the bank's risk exposures and making sure these risks are within the defined risk appetite, make adjustments to the risk management framework as new risks emerge. The bank's senior leadership reports to the Enterprise Risk Committee, including the CEO, the CFO, the COO, and the CRO. This senior group is ultimately responsible for how risk is governed at that bank. Reporting to the CRO, different risk committees will manage the bank's exposure to specific risks, such as the Market Risk Committee, Credit Risk Committee, and Operational Risk Committee. These risk committees work on a day-to-day basis with the different lines of business to identify, measure, monitor, and control all the various types of risks that the bank is exposed to. The Enterprise Risk Management Framework is a bank's critical roadmap describing its risk management and governance approach. However, an ERM framework will not run itself. Banks require a strong risk leader with the expertise and experience to implement the ERM framework effectively. The Chief Risk Officer, or CRO, is the senior executive at the bank responsible for implementing the ERM framework. The CRO's role and responsibilities depend on the bank's business model, for example, investment banking versus retail banking, size, and the complexity of the bank. The CRO is not expected to get involved in the day-to-day implementation of the bank's risk management policies and processes, but rather oversee risk management and drive the development of internal controls to minimize internal and external risk. As the most senior member of the organization's risk management function, the CRO guides other risk personnel so they can effectively identify, analyze, and address the potential risks to the company. The CRO also governs information security, cybersecurity, and compliance processes. They implement and monitor procedures to protect the company against fraud, safeguard its intellectual property, and reduce risk exposure. Ask any chief risk officer about how their bank organizes itself to protect it against risk. They will all respond the 3 lines of defense. Companies across many industries use the 3 lines of defense model. It was developed as an internal audit model to help describe the relationship between frontline business units, the risk management function, and the internal audit function itself. The first line of defense is the bank employees who are involved in creating and selling products and services or operationally supporting customers, products, and services. They are the risk owners. They are responsible for identifying and managing risk as part of their accountability for achieving objectives. Collectively, they should have the necessary knowledge, skills, information, and authority to operate the relevant policies and procedures of risk control. The second line of defense is the risk management function within the bank. They provide the policies, frameworks, tools, techniques, and support to enable risk and compliance to be managed in the first line. They also conduct monitoring to judge how effectively the first line of defense is managing risk and help to ensure consistency of definitions and measurement of risk. Finally, the third line of defense is the internal audit function within a bank. Internal audit reports directly to the board and board-level audit committee. Internal audit acts as an independent function, ensuring that the first two lines of defense operate effectively and advising how they could improve their risk management processes. A risk-based approach evaluates the effectiveness of governance, risk management, and internal control of the bank's board of directors and senior management. After the global financial crisis of 2008, regulators and the public reflected on how excessive risk-taking at banks contributed to the depth of the economic recession that followed. This excessive risk-taking is an example of the danger of not having an appropriate risk culture within a bank. So what is risk culture? Well, risk culture generally refers to the behaviours and attitudes encouraged by senior management towards risk, as well as the discussions and decisions made on risk management. It incorporates the shared values and goals embedded into a bank's enterprise risk framework. Risk culture has become an object of focus by regulators and senior management, but there's no consensus on exactly what it is or how it might be managed. It's hard to quantify risk culture because it comprises many qualitative elements. So instead, let's just focus on three elements regarded as critical to embedding a strong risk culture within a bank. Firstly, the tone at the top sets a bank's guiding values and ethical climate. A management team and board that places importance on managing risks are integral to creating a strong risk culture. Secondly, there should be clear lines of risk accountability and ownership. Clear accountability and ownership includes having an effective three lines of defense model, a strong risk management function, and clearly defined processes for escalation when risk owners observe risk limits have been breached. Remuneration schemes are another critical dimension of risk culture. Bonuses are often paid on key performance indicators, or KPIs, and should reward behaviours which are properly aligned with prudent risk-taking. Crucially, a bank with a strong risk culture protects customers, the bank's reputation, and the bank's bottom line. In this course, we gave recent and real-life examples of what happens to banks if and when they get their risk management wrong. We explored the evolution of risk management within banks and financial institutions. Critically, we identified all the risks that banks and financial institutions are exposed to and gave you the background you need to understand why managing that risk is important. Finally, we described why managing risk at the enterprise level is important and outlined the steps in an effective enterprise risk management framework. Effective risk management is critical in today's financial institutions. There are more opportunities than ever before for people to forge a career in risk management. You can use the knowledge in this course to acquire further expertise and start planning for an exciting career in risk management. It's been a privilege to guide you through this course, an introduction to risk management, and I hope to see you on another CFI course soon.